Lesson 4. Financial markets. Capital markets play a crucial role in modern economies by facilitating the flow of funds between those who need capital and those who have surplus capital. They serve as the backbone for economic growth, allowing businesses and governments to raise funds for various projects and initiatives. This section will delve into the two main components of capital markets: stock markets and bond markets. Capital markets consist of primary and secondary markets, which provide platforms for the issuance and trading of financial securities, such as stocks and bonds. In primary markets, companies and governments issue new securities to raise funds directly from investors. Once issued, these securities are then traded among investors in secondary markets, determining their market prices and providing liquidity for the initial investors. Stock markets are platforms where shares or stocks of publicly traded companies are issued and traded. Stocks represent fractional ownership of a company, granting shareholders voting rights and a claim on the company's profits. There are two types of stocks: common and preferred. Common stocks offer voting rights and dividends, while preferred stocks provide a fixed dividend but generally do not grant voting rights. Initial public offerings, IPOs, mark a company's entrance into the stock market. During an IPO, a company issues new shares to the public, allowing investors to purchase ownership stakes in the company. IPOs are regulated and require companies to provide extensive financial information to potential investors. Major stock exchanges, such as the New York Stock Exchange, NASDAQ, and the London Stock Exchange, LSE, facilitate the trading of stocks. They use trading mechanisms like auction and dealer markets to match buyers and sellers. Stock indices like the S&P 500, Dow Jones Industrial Average, and NASDAQ Composite track the overall performance of specific market segments. Investors use different methods to analyze and value stocks. Fundamental analysis involves assessing a company's financial health by examining financial statements, valuation ratios, e.g., price to earnings, price to book, price to sales, and conducting discounted cash flow (DCF) analysis. Technical analysis employs chart patterns, trends, and indicators, e.g., moving averages, RSI, MACD, to predict future price movements. Behavioral finance focuses on understanding investor psychology and market sentiment. Bond markets are platforms where debt securities, such as government, municipal, and corporate bonds, are issued and traded. Bonds are essentially loans that investors make to the issuing entity, which promises to pay periodic interest and return the principal amount upon maturity. The bond market is a critical source of financing for governments and corporations. Bond pricing and yield are essential concepts to understand when investing in bonds. Interest rates have an inverse relationship with bond prices, meaning that when interest rates rise, bond prices fall, and vice versa. Yield to maturity, YTM, and current yield calculations help investors compare bonds and determine their potential returns. Credit ratings are a crucial aspect of bond investing, as they reflect the creditworthiness of the issuing entity. Credit rating agencies like Standard & Poor's, Moody's, and Fitch assign credit ratings based on their analysis of the issuer's financial health and ability to meet debt obligations. Credit ratings directly impact bond yields and prices, as higher-rated bonds are considered less risky and have lower yields compared to lower-rated bonds. While stocks represent ownership in a company, bonds are debt obligations that the issuer must repay. Stocks provide shareholders with the potential for capital appreciation and dividends, while bonds offer periodic interest payments. Stocks generally carry higher risk but also have higher return potential compared to bonds. Additionally, different tax implications apply to stocks and bonds, depending on factors like holding. Money markets are essential components of financial markets, providing a platform for short-term borrowing and lending of highly liquid, low-risk financial instruments. These markets help organizations manage their cash flow and provide investors with a relatively safe place to park excess funds. In this section, we will discuss the main instruments traded in money markets: Treasury bills, commercial paper, and certificates of deposit. Money markets are characterized by the trading of short-term debt securities, typically with maturities of 1 year or less. These markets are crucial for maintaining liquidity in the financial system and facilitating short-term financing for governments, financial institutions, and corporations. The low-risk nature of money market instruments makes them attractive to investors seeking stability and preservation of capital. Treasury bills, T-bills, are short-term government debt securities issued by the U.S. Department of the Treasury. They are considered among the safest investments, as they are backed by the full faith and credit of the U.S. government. T-bills are issued with maturities of 4, 8, 13, 26, and 52 weeks and are sold at a discount to their face value. Investors earn a return by holding the T-bills until maturity, at which point they receive the full face value of the security. T-bills play a vital role in stabilizing the money market and setting short-term interest rates. They are also used by central banks in open market operations to manage the money supply and influence short-term interest rates. Commercial paper is an unsecured, short-term debt instrument issued by corporations and financial institutions to meet their short-term funding needs. Maturities generally range from a few days to 270 days, and interest rates on commercial paper are typically lower than those on bank loans due to their short-term nature and the creditworthiness of the issuing institutions. Commercial paper is issued at a discount, similar to T-bills, and investors earn a return by holding the instrument until maturity. Due to the lack of collateral, credit ratings play a significant role in determining the interest rate on commercial paper. Highly rated issuers can secure funding at lower rates compared to those with lower credit ratings. Certificates of deposit, CDs, are interest-bearing, time-sensitive deposit instruments offered by banks and other financial institutions. They provide a fixed interest rate and have varying maturities, typically ranging from 1 month to 5 years. CDs require the investor to keep their funds deposited for a specified period, and withdrawing funds before the maturity date may result in a penalty. CDs are considered low-risk investments, as they are insured by the Federal Deposit Insurance Corporation, FDIC, up to a certain limit, currently set at $250,000 per depositor, per institution. The interest rate on CDs is generally higher than that on regular savings accounts, making them an attractive option for investors seeking higher returns while preserving their capital. Money market instruments play a crucial role in portfolio management, providing investors with low-risk, liquid options to diversify their portfolios and manage short-term cash needs. These instruments can help mitigate portfolio volatility and offer a relatively stable return, making them suitable for conservative investors or those seeking capital preservation. Additionally, money market funds, which invest in a diversified pool of money market instruments, offer investors an accessible way to gain exposure to this asset class. In addition to capital and money markets, foreign exchange, forex, and derivatives markets play a significant role in the global financial system. These markets allow investors, businesses, and governments to manage risks, access capital, and engage in international trade. This section will cover the basics of foreign exchange and derivatives markets, highlighting their importance in global finance. Foreign exchange markets facilitate the trading of currencies, enabling businesses, investors, and governments to convert one currency into another. This market is decentralized and operates through a global network of banks, financial institutions, and electronic trading platforms. Forex markets are open 24 hours a day, 5 days a week, making them highly liquid and accessible. In Forex markets, currencies are traded in pairs, with one currency quoted against another. For example, the EUR-USD currency pair represents the exchange rate between the euro and the US dollar. Exchange rates fluctuate constantly due to various factors, such as interest rates, economic data, and geopolitical events. Forex market participants include banks, financial institutions, corporations, governments, and individual investors. Participants engage in Forex trading for various reasons, such as facilitating international trade, hedging currency risks, or speculating on exchange rate movements. Trading strategies employed in Forex markets include fundamental analysis, technical analysis, and algorithmic trading. Derivatives markets involve the trading of financial instruments whose value is derived from an underlying asset, such as stocks, bonds, commodities, or currencies. Derivatives can be traded on organized exchanges or over-the-counter, OTC. They are primarily used for risk management, speculation, and arbitrage. There are several types of derivatives, including futures, standardized contracts that obligate the parties to buy or sell an underlying asset at a predetermined price on a specified future date. Options: contracts that give the holder the right, but not the obligation, to buy or sell an underlying asset at a specified price on or before a specified date. Swaps: contracts in which two parties agree to exchange a series of cash flows based on an underlying asset, such as interest rate swaps or currency swaps. Forward contracts: customized agreements between two parties to buy or sell an underlying asset at a predetermined price on a specified future date. Derivatives can be used for various purposes, such as hedging. Businesses and investors use derivatives to protect themselves against adverse price movements in the underlying asset. Speculation: traders use derivatives to profit from anticipated price changes in the underlying asset. Arbitrage: investors exploit price discrepancies between related financial instruments to generate risk-free profits. Foreign exchange and derivatives markets provide investors with tools for risk management, diversification, and exposure to various asset classes. Forex trading can help investors hedge currency risks and benefit from exchange rate fluctuations. Derivatives, such as options and futures, allow investors to manage risks related to interest rates, credit, or market volatility. Additionally, these markets can offer opportunities for sophisticated trading strategies, such as arbitrage and algorithmic trading, which can enhance portfolio performance. Financial markets bring together a diverse group of participants, each with their own objectives and strategies. Market participants can be broadly categorized into individuals, institutions, and governments. This section will discuss the roles and motivations of these various market participants and their impact on financial markets. Individual investors, also known as retail investors, are private individuals who invest their personal capital in financial markets. They seek to build wealth, save for retirement, or achieve other financial goals. Individual investors typically invest in stocks, bonds, mutual funds, exchange-traded funds, ETFs, and other financial instruments. Individual investors' motivations can include capital appreciation, income generation, and capital preservation. They may use various investment strategies, such as value investing, growth investing, or income investing, depending on their risk tolerance and investment objectives. Institutional investors are organizations that invest large sums of money on behalf of their clients or members. They play a significant role in financial markets due to their size and influence. Examples of institutional investors include mutual funds, pooled investment vehicles that collect funds from individual investors and invest in a diversified portfolio of financial securities. Pension funds, entities that manage retirement savings for employees and invest in a range of assets to generate returns and meet future liabilities. Hedge funds, investment funds that use advanced strategies, such as leverage, short selling, and derivatives, to generate high returns for their investors. Insurance companies, firms that invest premiums received from policyholders in financial markets to generate returns and cover claims. Endowments and foundations, organizations that manage and invest funds to support their missions, such as universities or charitable organizations. Institutional investors typically have access to more sophisticated investment tools, research, and strategies than individual investors. They often employ portfolio managers and analysts to optimize their investments and navigate market fluctuations. Governments and central banks are major participants in financial markets, as they issue debt securities, manage currency reserves, and implement monetary policies to maintain economic stability. Governments issue debt securities, such as Treasury bonds and bills, to finance public expenditures and projects. These securities are considered low-risk investments due to the creditworthiness of the issuing government. Governments also engage in foreign exchange markets to manage their currency reserves and stabilize exchange rates. Central banks play a crucial role in financial markets by implementing monetary policy, which involves managing interest rates, money supply, and inflation. They use tools like open market operations, reserve requirements, and discount rates to achieve their policy objectives. Central banks also act as lenders of last resort, providing liquidity to financial institutions during times of crisis. The diverse group of market participants contributes to the efficient functioning of financial markets by providing liquidity, price discovery, and risk-sharing mechanisms. The actions and strategies of these participants can influence market prices, volatility, and trends. Understanding the motivations and behaviors of various market participants can help investors make more informed decisions and navigate the complexities of financial markets. The stability and integrity of financial markets are critical for maintaining investor confidence and promoting economic growth. Market regulation and the role of central banks are essential in ensuring the proper functioning of financial markets, protecting investors, and maintaining financial stability. This section will discuss the main aspects of market regulation and the role of central banks in overseeing financial markets. Market regulation involves the establishment of rules and standards to govern the activities of financial market participants. Regulatory bodies are responsible for monitoring and enforcing these rules to maintain fair, transparent, and efficient markets. The main objectives of market regulation include protecting investors, ensuring that market participants act in the best interests of investors and provide accurate and timely information for investment decisions. Ensuring market integrity, preventing market manipulation, insider trading, and other fraudulent activities that undermine the fairness and efficiency of financial markets. Promoting financial stability, identifying and mitigating systemic risks that can lead to financial crises and economic downturns. Several regulatory bodies oversee different aspects of financial markets at the national and international levels. Some examples include U.S. Securities and Exchange Commission, SEC. The SEC regulates securities markets in the United States, ensuring transparency, investor protection, and market integrity. Financial Industry Regulatory Authority, FINRA, a self-regulatory organization that oversees broker-dealers and other market participants in the U.S. securities industry. Commodity Futures Trading Commission, CFTC. The CFTC regulates futures and options markets in the United States, focusing on market integrity and investor protection. European Securities and Markets Authority, ESMA. ESMA is responsible for ensuring the stability, integrity, and efficiency of financial markets within the European Union. International Organization of Securities Commissions, IOSCO, a global organization that brings together securities regulators from around the world to promote cooperation and the development of consistent regulatory standards. Central banks play a crucial role in maintaining the stability and integrity of financial markets through their monetary policy and supervisory functions. Key responsibilities of central banks in overseeing financial markets include implementing monetary policy. Central banks use various tools, such as open market operations, interest rate adjustments, and reserve requirements, to manage money supply, inflation, and economic growth. Supervising financial institutions. Central banks oversee the activities of banks and other financial institutions to ensure their solvency, liquidity, and adherence to regulatory standards. Acting as a lender of last resort. In times of financial stress or crisis, central banks provide emergency liquidity to financial institutions, preventing widespread bank failures and mitigating systemic risks. Ensuring financial stability. Central banks monitor the financial system for emerging risks and vulnerabilities and take preemptive measures to maintain stability and prevent crises. Efficient coordination between regulatory bodies and central banks is essential for maintaining financial stability and addressing cross-border financial risks. This coordination involves sharing information, collaborating on rulemaking, and engaging in joint supervision and enforcement activities. International organizations like the Financial Stability Board, FSB, and the Bank for International Settlements, BIS, facilitate cooperation and coordination among central banks, regulatory bodies, and other financial authorities. In conclusion, market regulation and the role of central banks are crucial for ensuring the proper functioning of financial markets, protecting investors, and maintaining financial stability. An understanding of the regulatory framework and the role of central banks can help investors navigate the complexities of financial markets and make more informed decisions.